For 30 years, we simulated an investor with the worst luck on earth. Every single month, they invested on the worst possible day, the exact monthly top, every month, for 3 decades. And they still ended up richer than everyone who waited for a big dip to buy. Not slightly richer. Richer than the person waiting for 10% dips. Richer than the person waiting for crashes. The worst timing in the world beat the patience everyone tells you to have. Buy the dip. Markets fall and your feed fails with the same advice. Don't buy now, wait for the pullback. Keep powder dry, get in at a discount. It sounds like wisdom. It's repeated so often it feels like a law of nature. So we tested it, 31 years, 7,802 trading days. Every number you are about to see comes from our own computation, and the full methodology and code are linked below because on this channel, trust me isn't an argument. First, precision, because buy the dip hides different claims, and we're testing the one actually preached to everyday investors. You have $1,000 to invest each month. The dip buyer holds it as cash and waits for the market to drop below its recent high, 2, 5, 10 or 20%, then deploys everything at the discount. That's the strategy. Not day traders buying red candles, savers waiting for a better price. The alternative is almost insulting. Invest $1,000 the day you have it. Every month, no waiting, no watching, nothing clever. That's our baseline. The arena, the S&P 500, January 1995 through December 2025. That window contains the dot-com collapse, the 2008 financial crisis, the 2020 crash, every size of dip a dip buyer could dream of. Everyone contributes the same $372,000 over the period. And 2 extreme benchmarks to frame it all. A perfect investor who buys each month at that month's exact low, and Arcus investor from the opening who buys each month at the exact high. Between those two lies every result timing could ever produce. Remember them both, they're the punchline later. 31 years later, invest immediately $1.8 million. Wait for 2% dips, 1.79 million, a whisker behind 99.4 cents on the dollar. Wait for 5% dips, 1.77 million, also close. Now watch what happens as the discipline gets more ambitious. 10% dips, 1.7 million, 94 cents on the dollar. And 20% dips, the crash waiters, the most patient people in this test, 1.6 million. 11% poorer than the person who never waited for anything. Quick honesty note before we go further. This is one market in one 31-year window, and past results never guarantee the next 31. What it can tell you is whether the claim survived the era it was preached in. It didn't, and notice the shape. Small dip strategies roughly tie. Big dip strategies lose badly. Patience didn't pay less here, it paid negative. Now the benchmarks, the cursed investor, worst day every single month for 31 years, finish with 1.74 million. That beats the 10% dip buyer, it beats the 20% dip buyer. To be fair, it does not beat the 2 and 5% dip buyers, they roughly tied with everyone near the top. But anyone waiting for a serious dip lost to literally the worst timing possible. Their problem was never when they bought, it's that waiting meant not owning the market at all. And the perfect investor, buying the exact monthly bottom every month with supernatural foresight? 1.86 million, 3% more than the person who did nothing clever, 3% for 31 years of perfection. That's the entire price pool timing was ever playing for. And the dips everyone waits for are a bet inside that tiny pool. Why does this happen? Not what you'd think. To buy a dip has to exist. But markets spend enormous stretches grinding at new highs, nearly half of all days in our test. The market offered no 5% discount at all, and through all of it, the dip buyer's money sits in cash, earning nothing, waiting. Our 10% dip buyer spent 55% of all days holding cash. the crash waiter, 74%, 3 of every 4 days out of the market. The discount they eventually captured was real, it just cost more than it paid. The dip is a small occasional coupon. Compounding is the whole store. One more myth while we're here, that dip buying is at least safer. It wasn't. Worst peak to trough loss along the way, 50 to 53% for every strategy in the test. When 2008 arrived, it didn't check which strategy you were running. The fair objection. You picked the start date that made your answer true. So we ran the entire test 5 more ways, starting in 1995, 2000, 2005, 2010, and 2015. Every dip threshold, every start decade, 20 strategy and decade combinations, including starting at the peak of the dot-com bubble, the single best moment in modern history for a dip buyer to look brilliant. Here's the full grid. The best result dip buying ever achieved, its absolute finest hour across 20 chances, was a win of 0.1%, a rounding error. Its worst? The investor who started in 2010 and waited for a 20% crash. They spent years in cash and finished 24% behind. That's the trade on offer. Upside capped at basically zero, downside that can cost you a quarter of your wealth. And remember, our test left out dividends. That understates everyone's real-world returns, but it understates the dip buyers most of all. Because every day in cash is also a day not collecting them. Include dividends, and every gap you just saw gets wider. This isn't our opinion either. Vanguard's research across the US, UK, and Australia found the same mechanism. Investing immediately beat holding cash back roughly 2/3 of the time for the same reason. Cash drag. What this does not prove, 3 honest limits, and they're on the receipts page too. 1 is one asset, the US index. A market that goes sideways for decades changes the math. Japan's stock market peaked in 1989 and didn't see that level again until 2024, 34 years. Dip buyers there had a very different life. 2. Our cash earned 0. In the high-interest world, waiting costs less, though the studies that include interest found the same winner. 3 is one error and mostly a rising one. We tested the claim as is actually preached. To index investors, in the market is preached about. Those are the boundaries. So, does buying the dip actually work? As actually used, holding your monthly investment hostage, waiting for a discount, the answer across 31 years and every start date we could throw at it? No. Small dips bought you a tie. Big dips bought you a loss. Nobody bought safety. And even perfect timing was only ever playing for 3%. The boring answer won. Money invested when you have it beat every clever version of waiting, and even beat pure bad luck. To be clear, this is a test of a claim, not a recommendation for your situation. We don't know your situation, and we're not in that business. What we're in the business of is receipts. The dip felt like a bargain. The waiting was the price. The claim, as sold, tested, busted. The code, the data, the full grid, all linked below. Check our work. That's the point.